You've probably heard someone say, "I bought some stocks," and nodded along like you totally understood. But here's an honest question. Do you actually know what that means? What you're really buying when you click that button? Most people don't. And I don't mean that as an insult. Nobody teaches this stuff in school. You learn about Shakespeare and the French Revolution, but not how the financial system that runs your entire life actually works. Today we fix that. By the end of this video, you'll understand exactly what a stock is, why it exists, how you make money from it, and what can go wrong. Let's go. Welcome to Econs FM. I'm your name. Every week we break down one economic concept that matters for your money, your career, or just understanding the world around you. No jargon without explanation. No complexity for its own sake. If that's your frequency, hit subscribe and the bell so you don't miss an episode. Before we talk about stocks, we need to talk about why they exist in the first place. Because stocks didn't appear out of nowhere. They were invented to solve a very specific problem. Imagine you want to start a shipping company in the 1600s. You need a ship. A ship costs the equivalent of millions of dollars today. You don't have that kind of money. Your friends don't either. The bank will lend you some, but not all of it. What do? This was the exact problem Dutch merchants faced in the early 1600s. Their solution was brilliant. They said, "What if we sell pieces of this voyage to anyone who wants in? You give us money up front, and if the ship comes back loaded with spices, you get a share of the profit. If it sinks, well, you lose your investment, but we all share that risk together." That was the birth of the stock. The Dutch East India Company, founded in 1602, is widely considered the first company to issue shares to the public. Over 400 years later, the concept is identical. Companies need money to grow. They sell pieces of themselves. You buy those pieces and share in the outcome. So, what is a stock? A stock is a unit of ownership in a company. When a business wants to raise money, hire engineers, open new offices, build new products, expand to new countries, it has two main options. It can borrow money and pay it back with interest, like a loan. Or it can sell pieces of itself to the public. Those pieces are called shares. And the act of owning those shares is what we call holding stock in a company. When you buy a share, you become a part owner of that company. Not a customer, not a lender, an owner, a shareholder. Let me make this concrete with real numbers. Apple, one of the most valuable companies in the world, has roughly 15 billion shares outstanding. That means the total ownership of Apple is divided into 15 billion equal pieces. If you own one share of Apple, you own 1/15 billionth of the entire company. Its factories, its intellectual property, its brand, its future profits, all of it. One tiny slice. Now that sounds almost meaninglessly small. But here's the thing, it adds up. And more importantly, it means you benefit every time Apple benefits. When they sell a new iPhone, launch a new service, cut costs, or grow revenue. As a shareholder, that value flows back to you. That's the deal. Now, how do you actually make money from stocks? There are exactly two ways. Every dollar you've ever heard of someone making in the stock market came from one or both of these. Way number one is price appreciation. This is the one most people know. You buy a share at a certain price. The company grows and becomes more valuable. Other investors want in. The price rises, and you sell for more than you paid. Here's a real example. If you had bought one share of Amazon in January 2015, it would have cost you around $300. By 2021, that same share was worth over $3,500. That's more than 10 times your money in 6 years, without doing anything except holding. That's price appreciation. But here's what drives that price up. It's not magic. It's not just hype. At its core, a stock price reflects what investors collectively believe the company's future earnings are worth. When Amazon kept growing, kept expanding into cloud computing, kept generating more profit, investors revised their expectations upward, and the price followed. When a company disappoints, misses earnings, loses a key contract, faces a scandal, The price falls because expectations fall. Way number 2 is dividends. This one is less flashy but incredibly powerful, especially over long periods. A dividend is a cash payment that a company makes to its shareholders, typically every quarter. It's the company saying, "We made a profit, and we're sharing some of it directly with our owners." Think of it like rental income. If you own a property, your tenant pays you rent every month just for owning the asset. Dividends work the same way. You own shares, the company pays you cash, regularly, just for holding them. Here's a real example. Coca-Cola has paid a dividend every single quarter since 1893, over 130 years without missing a payment. If you own 1,000 shares of Coca-Cola today, you receive roughly $1,140 per year in dividends, just for holding the stock. You don't need to sell anything. The cash just arrives. Now, when you combine price appreciation and dividends over long periods, the results are extraordinary. $10,000 invested in the S&P 500, an index of the 500 largest U.S. companies, in 1993 would be worth over $180,000 today, with dividends reinvested. That's not a stock tip. That's just time and compounding doing their work. Here's what nobody leads with. Stocks can go down, not just a little, sometimes a lot. And if you're not prepared for that mentally and financially, it can cause you to make terrible decisions at exactly the wrong moment. Let's talk about real losses. During the 2008 financial crisis, the S&P 500 fell 57% from peak to trough. That means if you had $100,000 invested at the peak, it became $43,000. On paper. The people who panicked and sold at the bottom locked in that loss permanently. The people who held, or better yet, kept buying, recovered everything and went on to significant gains as markets recovered. Individual stocks can be even more brutal. Enron was one of America's most celebrated companies in the late 1990s. Its stock hit $90 and $2,000. By late 2001, it was worthless. The company was a fraud. Shareholders lost everything. This is called the risk-return trade-off, and it is the single most important principle in all of investing. There is no such thing as high return without high risk. Anyone promising you guaranteed 20% annual returns is either lying or selling something dangerous. The higher the potential reward, the higher the potential loss. That's not a bug in the system. That's the fundamental law. This is also why diversification exists, owning many different stocks across many different companies and sectors, so that one company going to zero doesn't destroy you. But we'll go deep on that in a future episode. So where do stocks actually trade? On stock exchanges. Think of an exchange like a giant marketplace. Except instead of vegetables or antiques, people are buying and selling ownership stakes in companies. The two most famous exchanges in the world are the New York Stock Exchange, or NYSE, founded in 1792, and NASDAQ, founded in 1971, and home to most major tech companies. In South Korea, you have the Korea Exchange, or KRX. Every major economy has its own exchange or set of exchanges. Now, how does a company get onto an exchange in the first place? Through an IPO, an initial public offering. This is the moment a private company, one that regular investors couldn't previously own, opens itself up to the public for the first time. Here's how it works. The company hires investment banks to help them figure out a fair price for their shares. They go on a roadshow, pitching to large institutional investors. They set an IPO price. On IPO day, shares start trading on the exchange, and for the first time, anyone with a brokerage account can become an owner. The company receives money from the IPO. That's the whole point. But here's something many people don't realize. After the IPO, the company doesn't receive any money from subsequent stock trades. When you buy Apple shares on the stock market today, Apple doesn't see a cent of that transaction. You're buying from another investor who's selling. The IPO was the one moment Apple cashed in. Everything after that is investors trading with each other. IPOs can be exciting, and they can be dangerous. The hype around an IPO often inflates the price beyond what's rational. Many famous IPOs have crashed in the months after listing. Uber went public at $45 in 2019 and fell to $26 within a year. Snap went public at $17 in 2017, fell to $5 within 2 years. The lesson: just because a company is famous doesn't mean its stock is a good investment at any price. Here's everything we covered today, pulled together. A stock is a unit of ownership in a real company, not a casino chip, not a lottery ticket. An ownership stake. You make money in exactly 2 ways: price appreciation when the company becomes more valuable, and dividends when the company shares profits directly with you. Stocks can and do fall, sometimes catastrophically, and understanding that risk is not optional. It's essential. Companies raise money through IPOs to get onto exchanges, and after that, investors trade with each other. The company is out of the picture. Most importantly, and I want you to really hear this, stocks are not a get-rich-quick scheme. They are a mechanism for owning pieces of productive businesses and sharing in their growth over time. The people who get hurt in markets are usually the ones who forgot that. Next episode, we're going deep on central banks, the Federal Reserve, the ECB, the Bank of Korea, and how the interest rate decisions they make in a conference room affect your mortgage, your savings account, your job, and your investments. It's one of the most powerful forces in the global economy, and almost nobody outside of finance actually understands how it works. Subscribe so you don't miss it. And if this video was useful, share it with one person who needs to hear it. I'll see you next week on Econ SFM.